Do you all have any advice for directors? You must deal with directors all the time on M&A. What should they do? What should they be asking you?
Well, no, I think it's an interesting time to be a director. As we talked about, the word of the day is uncertainty, and in uncertain times, you need to have a lot of discussions with your management team about the strategy going forward. How making sure you're up to speed on how all of this whipsaw back and forth with the new rules every other day, how that is, affecting the business. A lot of vigilance on how that is affecting the business, but there is still the strategic aspects of it, and making sure that we don't get so caught up in the day-to-day changes that we're not thinking about the long-term strategic plan of the group.
Yeah, I would say, well, first thing I would say, you should hire a good investment banker and pay them well. No, all joking aside, and I do deal with it, candidly, a lot of directors and have a lot of board meetings and all that stuff. And, I think Stephen's right. I think listen, I think for the most part, the directors are, a terrific group. And, I think it's an incredibly difficult task. What I would say is exactly right. I mean, and I think you're all well aware of this, but you're making very long-term strategic discussions or decisions for the companies. And so I think, really looking at, not what's going to affect the company in the next 3 months or 6 months, but what does this mean for where the company is going to be over the next 3 to 5 years? So.
Yes. I swiped it every way. I think we don't have enough electricity.
Other questions?
Any questions?
When technology fails you.
I was going to say for board members, thank you. Now don't touch it, Chip. My wife said. Like Stephen said, as board members, stick your nose into the business at board meetings. Raise the issue every time. Should we be buying? Should we be selling? Holding still? Find out what management wants to do, what they will not do. You need to find out early if your comp is set up right so that there's enough change of control incentive that they might actually sell the company. And you need to look at the other board members and see if they want to ever sell the company. A lot of board members view this as salary for life and don't really want it to go away. All that going on at once. At the same time, you need to be always working on who in the company is critical that we need for retention if we do start negotiating. Because even if you just start negotiating with somebody, buy or sell, people find out, and then do your best people hit the road. And so you need somehow to identify them, figure out which extra you're going to pay them and incentivize them to stick around. And then from my own experience, communication. As a board member, you somehow need to be, once you start negotiating, talking to the board of the other company. And this can be chairman to chairman with the CEOs there, but you shouldn't just rely on management to carry this out and keep bringing you things and listening to your bankers. And bankers, no offense, but they never come in and say, this is a bad deal. And we can't figure out how to make this accretive. I've never seen a deal that wasn't accretive. And I never realized how much my cost of capital could be manipulated to make the answer come out right. But in any case, if we lost the biggest deal I was ever involved in because my board and me thought we knew what the other company was doing because I was talking to management over there all the time. And when it got down to the very end in 2014 and the other CEO went to his board and said, I've made a deal to take over this company and I want you to prove it. And they had never heard anything about it. And they basically said, no. And no, but hell no. And we really don't even want to hear about it. And so the whole thing died right there, or I'd probably be sitting at Augusta right now in one of the cottages.
But yeah, on M&A specifically, since you brought up some of the stuff you need to be aware of, I would really focus and really pressure test your management teams on the projections. It's going to be really difficult right now to have really good projections, but if you are going to do a transaction, it is going to matter what your projections are going forward and what the counterparties are if you're going to do a stock for stock deal. And you've got to make the decision based on, do I really believe in this? And the only way to do that is really to dig in, ask the questions. Like, it shouldn't just be, and usually they will bring Tim in and he'll assist with the preparation of the projections, but it shouldn't just be a presentation to you. And ask questions like what assumption is underlying all of these inputs. And really, the more you can feel confident in your company's projections, and particularly if you're going to do a deal in the space, you can feel more confident in the projections for the other company. But that will make you more confident in your decision to either say no or to say yes to a deal.
Yeah, you need outside help. Relying on the bankers for all the forecasts and the technical work is very dangerous. Last year on our Southwestern Chesapeake deal, we brought in RBC midway through the process because they were so good technically. And then we had board members sit down with them and go through individual drill sites and try to prove that our net asset value was correct, and so was Chesapeake's. And most people would just say net asset value doesn't even matter. All we have to do is look at your relative multiples and is it accretive, and you should do this deal. But you don't want to get finished with the deal and find out you can't drill any of the wells you thought were in the package. So that's important. You need help on things like tax loss carry forwards. I've never met a banker who can do that. I never met anybody in our company that can do that. But you have to go to a big firm that has people that know how to do that. And it's super complicated. And I knew it, I understood it for about a day. But that was a big enough part of the deal that it would have wrecked the entire deal if we'd done it wrong. And nobody even knew that going into it. So you have to know about the other company's debt structures, your debt structures. Normally you need to hire somebody like an EY or a McKinsey to help you with that. Can we do this deal? Can we take out their bonds? Is there a GSO in there somewhere that we can't deal with, and we're going to have to give them a lot of money to go away? I mean, there's just a lot that doesn't come across in the pitch book, and you need outside help to do that. It's my 10 cents.
A transaction opportunity where you have entrenched executives and board members alike that really don't want to lose their spot? And they know when the market's going like this, there's not another seat to go to. So they really, like, their self-interest. And how do you motivate, especially directors, especially when their accumulated stock has not really performed?
Go ahead.
Sylvia, I think that kills more deals. That topic that you just brought up, that kills more deals than I think a lot of, and just about any other factor, the social impact. One thing you can do as directors, so it's really difficult to look at your colleagues and kind of put a motive on them, right? Because you all are working together and have a lot of respect for each other, but you've got to be attuned to that. But the one thing, it's a little bit easier to make sure that management is motivated, and you touched on this a little bit, periodically reviewing the overall compensation, the severance structure, how your long-term incentives are treated in a change of control, to the point that management may not be like jumping for joy to sell the company because they are going to lose their jobs, but they also do have an advantage if they do leave, that they'll get a severance package that's within market, but also encourages them to do that. It's usually the compensation issues that stop management teams from really being candid with their boards.
Yeah, I'd say, well, a couple of things that might interest you. First of all, from an M&A practitioner side, and pitch books and so on and so forth that Chip was trying to talk about. Whenever we do M&A analysis and we're working for a client, we always look at the target if it's a public company, and we look at what is the change of control and management and what is the ownership of the board, because you're exactly right. And we fathom that in there. And that is a consideration when, like, should we approach this target? There's a number of things we look at before we decide to approach a target or not. That is one of the factors. And what I would say is directors, it's always a really difficult thing that, about pay and compensation of your employees and management team. But the real answer is you do want them to be aligned with shareholders, and paying them relatively high change of control is not necessarily a bad thing, because it will put their incentives in the right way. I will also tell you that from Wall Street investors, how they look at it, they think it's a good thing as well for exactly the reasons we're talking about. And i.e., the issue is like, am I overpaying these people, or am I incentivizing them to do the right thing and be aligned with shareholders on a potential M&A deal? Generally, where shareholders are, where investors are, is you'd rather have them paid well. So that is not an area that you want to be skimpy on, in my opinion.
Now, and an outside factor, which I never thought I'd say this, is activists can be helpful this way. Cambridge puts out a white paper every year that talks about why companies should merge and we should get rid of all the wasteful G&A in the business. And nobody likes the guy or likes the company, but he's right almost every year. And once an activist starts pointing that out to you, your board starts paying a lot more attention to that, because they feel like something bad could happen. They could lose their jobs, or there could be lawsuits. That I don't like to support activists, but they do serve a useful purpose sometimes. I had a question regarding HSR and FTC. What will they look at in the services business instead of the commodity business? Do they see problems? Will they be roadblocks in anything that's service-based?
I mean, services are pretty fragmented, but again, they're looking for signs of oligop. Never say that word. They're looking for such consolidation that it would affect competition, and they do tend to. The one thing they do is different from maybe the oil markets is they are really more focused on the geographical areas and the basins themselves, and so it's a little bit. I think I don't know the exact rule of thumb there, but it's a little bit lower in the various areas. Like, but in terms of like a fracking company in the Permian, they would have to have a pretty big part of the industry for it to really draw some concerns. I think, again, it's such a fragmented group. I think there's a lot of ability to get deals done in that area.
Yeah, I kind of agree the same thing. The key thing you do want to look at, similar to the commodity markets, is, again, it gets into control, it gets into percentage of revenues relative to the overall industry. And then, again, the real key to that isn't so much what your revenues are, the numerator. The real issue is, what is the denominator? And as Stephen was saying, is it worldwide sales of widgets, or is it sales in this particular region of the country, or is it the U.S.? That is the key driver. And there's widely different views of that, frankly.
We had a question on cross-border M&A this year. Do you guys think that's going to happen? I guess it depends on which border.
Yeah.
I know one that won't happen, but
I mean, I think our general view is that's going to be challenging, just in the current market. With all the uncertainty, with the varying different regimes, I'm more focusing my time and energy looking for deals in the U.S.
Yeah, I would say, as we sit here today, virtually impossible because we really don't. I mean, please tell me where we're going to be with Canada in 30 days or 60 days. I don't know. I'll probably be a little more optimistic than that, which is if you do get, with various countries like Canada or Mexico or whatever, or Europe, if you do start to get these tariffs really actually settled and real handshake agreements and in writing, actually that may really open the opportunity for, frankly, doing a lot more deals going forward. So again, as we sit today, I think it's virtually impossible, but we may feel very different about that in 2 or 3 or 6 months, I'd say.
Yeah, just right now.
Yeah.
The one thing I will say about Canada, and this preceded obviously the election because I was dealing with this fall. Canada, their version of the FTC and the DOJ, they have been emboldened by their government to be a little more forthright and to not necessarily, like if you're doing a U.S. Canadian deal, just because the FTC or DOJ clears it out on the U.S. side, they still want to look at it and scrutinize things. I actually had a deal that had gotten HSR approval. They have a waiting period in Canada. It's 30 days as well. Got zero indication from the Canadians that there was a problem. And then on day 29 or maybe even day 30, they came and asked for a whole bunch of new stuff. And it was surprising to me that they would go that route. And then we got stuck in Canadian antitrust for 2 or 3 months and couldn't get the deal closed. Eventually we got through it. But again, you're seeing, at least in Canada, you're seeing a renewed spirit on them in terms of scrutinizing their transactions.
But we'll talk about Canada maybe just for a second. And I know it's isolated, but it's been in the news. And maybe just a little bit of context what's going on there, because it's pretty fascinating. I mean, you've heard all the rhetoric, the 51st state, blah, blah. But what's going on in Canada right now is that if you roll it back to end of last year, is that basically the Republican Party of Canada was 20 points ahead in the polls. And then the rhetoric that came out in the 51st state, they went from 20 points ahead in the polls to only 7%. And so the Trudeau stepped down. They have a new premier, if you will, a president of the country. He has now asked for an election. I believe it's April 28th. I think that's right. Is that the right date? So a very, very quick election. Their election cycle is similar to the UK, which is really, really tight, very unlike the US. So getting back to Stephen, I think with respect to Canada, what's really going to be interesting is, one, where do we sit on tariffs? And then two, what happens in this election? And we really don't know which side it'll be. If it is basically the more conservative party in Canada and you got the tariffs worked out, we might start to see a lot of interesting M&A with Canada, and that's particularly also in the energy industry, if you will. On the other hand, if the existing party, I think they're going to be much more restrictive. The other end of the barbell, I think they'll be much more restrictive on cross-border M&A, more regulatory overseeing, combined with, if we don't work out the tariff with them, it'll be actually just the opposite. It'll be really difficult. I'm on the optimistic side with Canada. They're just too important a party. I don't know which party will win, and so on and so forth, but we're going to have to work out some type of relationship on the positive side with that country.
I have a question on board involvement and integration after the merger or during the negotiation. And again, I would be proactive as a board member getting involved in that. I think the best integration I saw was where Southwestern and Chesapeake had a board level committee with management that did the integration process. And that takes out a lot of individual feelings and makes management justify the personnel decisions they're making, and is probably the best thing for the seller to have more weight in the room when you're deciding who's going to get cut and who's not. And the other thing, I guess, that goes along with that are the synergies. That's the magic sauce that can make every deal work. And they're always too high when you look at the projections that we're going to make $400 million a year by combining these two companies. And you need to dig into those numbers and find out what's real, what's not, what's duplicated. And then after the deal, somebody has to follow up on that. And my experience is management does that for about 2 quarters, and then everybody loses interest. And Wall Street quits asking also, but those are serious numbers, and you can leave a lot of money on the table if you don't carry through on those synergies. And there are people like McKinsey that'll send a team for a lot of money that will help you find those.
Mhm.
But anyway, that's more of the same.
That committee that you were talking about, Chesapeake, was that post closing?
No,
It was in the
Yeah.
lead up. So the one thing you do have to be a little bit careful about is until you get regulatory approval, you can plan for integration, but you actually can't start integrating. You can't start, making drilling decisions or hedging decisions for the other company. And so there is a little bit of dance there you have to be careful about. But I do think anything that gets board oversight always ends up being better than if it's just left to the management teams. So,
Yeah, I completely agree. All that. I mean, we do most things in the U.S. much better than we do in Europe in terms of running companies. But one thing they probably do, in my opinion, better in Europe, and you are starting to see more of this in the U.S., is frankly executive chairman. And you are starting to see an executive chairman that, they're not the CEO, but they're very involved in the business and from a CEO standpoint. And I think board involvement more with the companies can be a really, really good thing because they do take a more independent view. And frankly, they don't have the same vested interest that management does sometimes, and it can be really helpful. So I'd say whether it's an executive chairman or any, head of a committee of a board, getting involved in the company, getting your hands dirty are really good things. And frankly, executive management, C-suite management should be supportive of that. And if they're not supportive of that, that probably is a red flag. Like, why don't you want to hear more about my business? So I think boards, because the problem is what really happens is what you all are really, as I was talking about earlier, and what I do spend, quite a bit of my time in front of boards is that, the challenge of management, and Chip, you've done it for many years, is that as a CEO job or CFO job, you got to get the trains to run on time, and you're so focused on what's going on the next quarter or the quarter after that and hitting those numbers, that's sometimes really hard to think about where is this company going in 2027 or 2030. And as a board member, you're not as involved in that day to day. And so you are able to think more about strategically, where is this company going? Where is the industry going? How can we reposition this company to be a leader in this industry? All those types of super strategic questions. And I think that is welcomed by C-suite because that's when, in my business, my observation is that's it, is that management gets, too focused on the trees and not enough on the forest, and where the board can really help is to make sure that the companies are focused on the forest and making those right strategic decisions.
This is just my experience, but my general counsel would tell me and the board every day that we were going to get sued if we didn't do this and this and this as directors and management. And you need to have 10 companies in the proxy that you talk to. You have to hold an auction, all these steps. And I haven't seen anybody have a serious suit in 10 years over something they did wrong during a merger. Is that true, false?
well, you're going to have the lawsuit. But the question is it going to matter, right? Because there is a lot of flexibility. And again, with the changes in the Delaware law, making it even more flexible, there is a lot of flexibility in how you run your process. The shareholder, it's more about the shareholders, I think. The shareholders want to understand, you're asking them, we're going to sell the company for $10 a share. And the reason we came up with that number is through what? And if you can to have a background of the merger that does say, we talked to all of the potential likely candidates, that goes a long way. I'll give a real world example. I sold Denbury to Exxon last year, and Denbury was a high flyer on the CCUS side. And a lot of people, when it first got announced, some shareholders questioned the premium that was there. And when they actually pulled out the background of the merger and realized that Denbury had talked to 26 different companies, and this was in fact the best deal that they could get for the shareholders, all that stuff went away. So I think there's a shareholder aspect to it in terms of being protected. Look, you have a lot of flexibility. You can do single bidder strategies as long as you allow for, in the merger agreement, an ability to reconsider if somebody does come out of the woodwork. There's no single blueprint on how you sell a company, but you do want legal counsel in there, because if you're going to take certain steps, you got to make sure that, like I said, you can negotiate one-on-one with somebody, but you better make sure that merger agreement gives you the flexibility. If in fact somebody is willing to pay more, you have an ability to exit. So there's all that stuff. I think you're right. Like, the lawsuits aren't the big thing. I think it's the shareholder acceptance. I think, and reputation.
One more interesting question. Do you think DOGE is going to help or hurt? That we get rid of a lot of bureaucracy and bureaucrats, but are we getting rid of people that are going to be necessary to make the decisions and get deals done?
I thought this wasn't supposed to be political. Honestly, I'll say I don't know. I don't know. I have concerns, about the level of the cuts. Obviously, we have a bloated bureaucracy and changes needed. I'm a little concerned about giving it to a very small group of people who by and large do seem to be very intelligent, but there's no way they're going to get it all right, and people are going to get hurt from it. I think there'll be benefits, and I think there'll be some disasters.
First of all, I mean, it's extremely personal and political. I guess I'd say this, maybe look at the data, you guys can judge for yourself. If we looked back 100 years ago, the federal government was roughly 7% of the GNP of the country. Today, it goes back and forth. People say different things, but most people feel it's in the high 20s to low 30s. So if you've had, over the last 100 years, you've had incredible growing GNP of the country, and yet as a percentage of those revenues, the federal government has even grown much faster than the population. The size of the federal different departments is large. It's very large companies. I work for RBC. We are the largest private employer in Canada, and we have about globally around 95,000 people. The Department of Energy, that's one of the departments, of course, we're here in Houston, 110,000 people. So it's going to be very interesting. If you look at those percentages, I mean, you should just cause into question. The other thing is, probably everyone knows about, is the federal budget, and basically when I say the federal budget, what I'm really talking about is, the deficit, if you will, is continuing to grow. So I think, the general consensus is that we have to get a smaller deficit. How do you do that? We can have a long debate and discussion about that. But certainly, if you do, one way to do that is reducing the size of the federal government as a total percentage of the GNP, which is what DOGE is going about. I do think, I will say, even if you're in favor of that strategically in the long term, short term, it's probably going to create a lot of, some problems, because you are going to have a lot of talented people lose their jobs, and then, efficiency is probably going to go down for some period of time. But, people know how to make things work more efficiently, and then over time, do you work through that, and then you have a federal government that's a smaller portion of the economy. And if you have that and you have a, you know, does that help in terms of the deficit long term? Those are the things I'd be asking.